believe we'd call this here. And the last one I want to look at, and we're going to go into in a little bit more detail later, is the channel breakout. And all a channel breakout is this is a series of highs and lows that it's establishing. In this particular case, this is a 50-day high and a 50-day low. And the idea is once the price penetrates the highest point of the last 50 days, or whatever number you use, in this case 50 days, you get a buy signal. And here we can see over here the price penetrated above the 50-day channel, produced a good buy signal. And this remained a buy, at least in this case, all the way till it penetrated the 50-day low, which produced a sell signal. And you can see the market trended nicely lower from there. And over here it repenetrated the 50-day high and turned back into a buy signal. And for those of you that are interested, this is a sugar chart. And again, I've used the same chart in each example for a reason. And that is to show you that regardless of the indicator you use, if your time frame is roughly the same, in this case we're looking at daily bars, generally speaking these indicators are going to show you buys and sells at close to the same point. Not exactly, but close. They're going to establish the same trends. Step number 3 is setting the stop loss point. And once we have entered into the trend using any one of our techniques, either one of the 8 that I've shown you or some of your own that you come up with, you need to establish a stop loss point, a point where we can basically say that we're wrong and it's time to get out of that trade with a loss. And we have to find a logical place to limit our risk. And there's a whole lot less leeway in setting stops because now you're in the market. You've got no choice. You have to get out. With an entry, you can sit back and wait for exactly your point. You might have 5 different indicators you need to line up just right to get in, and you can sit back and wait. But once you're already in the market and you've got money at risk, you can't sit back and wait for 5 different things to occur in order to get out. You have to have some pretty quick rules to get you out of a losing trade. And stop losses are really a balancing act between setting stops that are too close and that just get you out from random whipsaws, and those that are too far away and cause too big of a loss. So what you need to do is kind of find that point in between where your stops are close enough to the market where they're not, you want them to be outside of the range of random noise. There's a lot of movement in markets that's random, really kind of meaningless in nature. And the idea is to have a stop that's a little bit outside of that randomness. And methods to set stops, I've got a list of 4 of them here. One of them is a fixed dollar risk amount, which I don't recommend. For example, using a $2,000 stop in every market. And the reason I don't recommend that is that each market is different in its weighting. Some markets may move around hundreds of dollars at a time, and other markets may move around thousands of dollars at a time. Which means if you're using a $2,000 stop for every market, you might have one market that hits that in a few minutes just from random meaningless noise. And you may have another market that by the time it hits a $2,000 stop, that trend is reversed a long time ago, and you should have been out way earlier. So, it's a popular method to use a fixed dollar amount of risk, and I just simply don't recommend it. You can use channel highs and lows, which we looked at as an entry point. I showed you the 50-day highs and lows as an entry. You can also use them as exit points, and you can use different channel lengths for the exits than you did for the entries. And I'm going to show you an example of that in a little bit here, where we use a 50-day channel high or low for the entry, and then use a 10-day channel low for the exit. Those are very good, in my experience, very good exit points. You can use moving average crossovers or moving average penetrations. Once again, another one I don't highly recommend just because a lot of times you don't know exactly where the market needs to go to get you out. In other words, you don't know till the end of the day that, oh, okay, we had a moving average crossover today. Well, the market might have moved too far by that point, and your losses might be too big. So that's not a, there's a number of systems that use that, and I'm not a real big fan of using those kind of exits. And then the last one I've got on the list here, the volatility-based stop, is my personal favorite, and I'm going to go into an example of this here. And what you're doing with a volatility-based stop, excuse me, is you're looking at the average price movement over a given period of time. In this case, I'm going to say over 15 days. And I want to see what's the average amount of movement per day. And let's use an example of 10. So the average movement over the last 15 days has been about 10, let's say 10 points a day. Either goes up 10 or down 10, and that's your average. So what you do is you take that range and you multiply it by a factor of your choice. In this case, we're going to use 3. But you can test this. You can multiply by a factor of 1 or 2 or 3, or I've seen 5. But in this case, we're going to use a multiple of 3. And once you've done that, this establishes your stop price. For example, let's assume that the 15-day average movement or average price range on a daily basis is 10 points. So on average, the market goes up about 10 points on any given day, or goes down about 10 points on any given day. There's actually a precise formula for figuring out the average true range, which is a little different than that, but for all intents and purposes, let's assume that the point range is about 10 points per day over the last 15 days. And incidentally, it doesn't have to be 15 days. You could look at the last 5 days, last 20 days, whatever you choose. So we multiply that 10-point movement times a multiple of our choice. In this case, I'm going to use 3. And there again, you could use any multiple you want. I've seen 1, 2, I've seen 5, but I'll use 3. So if we take the 10-point range, multiply that times 3, that gives us 30. And let's assume we bought into the market at 100. So if we bought in at 100 and our stop price is 30 points away, that means we'd get out if the market traded down to 70. And if we had sold the market at 100 and our stop price is 30 points away, that means we'd get out at 130. And what I like about this exit is that it's very dynamic and it's very individualized to that market. A market that has a low degree of volatility is going to have stops very close. And a market with a high degree of volatility is going to have stops very far away, as it should be. And so again, a very good exit, one I encourage you to use and test in your back testing. Step number 4, the exit or the exit timing. Oftentimes, the exit is the most important part of the timing process. When you think about it, exits are really what determines profits and losses. Interesting study that you can do in backtesting. I've done it, others have done it, and that is to get into a market at random. Just have a random entry and use a good exit methodology. And what you'll find is that you can actually produce successful systems doing that. I'm not saying they're good systems. Obviously, there's others that are much, much better than that. However, it is interesting that you can produce a profitable system with a random entry. To give you another example, you could have 2 traders that get into the same market at the same time, going the opposite direction, and both of them make money based on time frame. One of them might be a short-term trader and he buys the market and makes money, and the other one might be a long-term trader who's sold the market and is holding on for a long term, and he ends up making money also. So there and again, just more proof that it's really the exit that determines whether your trade is going to be a winner or a loser. And some examples of exits, I'm not going to go into deep detail with this because what you'll find is that what we looked at with the entries, you can oftentimes just simply use the inverse with the exits. Not always using the same time frame. It's very common that you'll use a shorter term version of the entry to get out, or excuse me, of the exit to get out of the entry. For example, if you've used a 50-day channel to get into an entry, you might use a 10-day channel to get out with an exit. But let's look at each one of these 7 points here just a little bit. Profit targets can be a successful exit. The only caveat there is, once again, you don't want to use a fixed profit target number. For example, $2,000 per trade. We talked about this with the stop losses, where one market could hit that $2,000 just from random noise, and another market could take months to get to a $2,000 profit target. So the profit target should be dynamic, and it should be something that is computed based on that given market's volatility. And often that's the best way to do it, is to compute multiples of the market's volatility as some form of a profit target. Trailing end day highs and lows. This is again the channels or the turtle method. Highly recommended. They work very well. Moving average penetrations. Should the market be in a long-term trend and you're trailing that market with a long-term moving average, and the price should come down and penetrate that moving average, either close below it or just penetrate it, either one could be used as an exit. Again, not highly recommended because you don't usually know till the end of the day after trading is over that penetration has taken place. And then you have to get out the next morning on the open, and the market might have moved too far by that point in time. Average true range retracements. This is often referred to as a chandelier exit. If you can envision a chandelier hanging from the ceiling, the logic is kind of the same. What you do is you take the ceiling in prices and you subtract from it a multiple of average true range. So let's assume the true range has been 10 points per day, and we talked about average true range a little earlier, and you want to get out at 2 multiples of that from the ceiling. So let's say the price gets as high as 100, that's your ceiling, and you're going to get out at 2 multiples of average true range less than that, which is 20 points less. So if the market gets to 100 and then subsequently drops to 80, that would trigger your exit. Very good exit. I've used those types of exits a lot, or at least variations of them, in various types of systems that I've developed. Then we've got trend line penetrations, a little bit more of a subjective kind of a exit, but still can be successful. Parabolic stop and reverse points, excellent exit. I've used those quite a bit myself. And volatility exits, also another excellent exit. And a volatility exit is similar to the chandelier, where you take a multiple of average true range, but instead of subtracting that number from the ceiling price, you subtract that number from the closing price of the day before, and that's your exit. And all of these you should experiment with in backtesting. I found over time that there really is no substitute for extensive backtesting. You know, I could tell you exactly which exits to use and exactly which entries to use, but if you don't take the time to experiment with them yourself,